Welcome back. HDFC Bank's numbers are dominating mindspace today. Results were mixed, but the important point to note is that although the profit is a beat, that profit has come because the bank has sold some of its investments in treasuries, in Government of India securities. Now, these Government of India securities are maintained by any bank for their liquidity coverage ratio, which means for 1 month, whatever depositors come and demand, that should be kept in liquid assets. That's an RBI rule. You should have ready money. So 1 month's cover, that is called the liquidity coverage ratio. HDFC Bank had 120% of the required amount. They have sold a bit, and now they have only 110% of what is required. Most good banks keep 120%. Now that 10% that they sold has given them a profit, and that's why there is a profit beat. But what is the underlying message? That raising deposits have become expensive. And that's why they had to sell investments to show a higher profit. Now, deposits cost has led to the bank's margins remaining a constant at 3.6. We are used to seeing HDFC Bank's margins at 4.2 for, 25 years, 30 years. So this indicates the struggle for HDFC Bank. Now, will it show on other banking results as well? Those are the questions that is bedeviling the market, and you're seeing this fall in the bank nifty, in the banking stocks, and in HDFC Bank itself. To analyze the impact of the HDFC Bank results on other banks and whether they will recover in FY25 and FY26, I have with me Santanu Chakrabarti, the India analyst, BFSI at BNP Paribas. Santanu has just written a report on FY25 and 26 for the banking sector. Santanu, good morning and thank you very much for joining us. Well, first up, before we go to the FY25-26, are you expecting this pressure on margins to show up in the other banks as well? Should we be prepared for the ICICIs and the Kotaks and the other banks?
Thank you, Latha. A very good morning to you. Before we just move on to the sector part, let's make one thing very clear about HDFC Bank. I saw that in your opening statement, you said that for the longest time, it has been a 4.2, 4.3% margin bank. One thing we have to be very clear about, that in its current avatar, in the blended format, the margins are not going to be 4.3 anytime soon, right? So what the market is really looking for and what we think is critical to the final re-rating is those margins getting closer to 3.9%. Because remember, the other part of the business which has been merged into it was a lower margin business, but at the same time, it was also a lower operating cost business. So the new HDFC Bank, Latha, will be a very similar bank once it matures at around 2% ROA, but the composition of that would be both a lower margin as well as a lower operating cost. With that out of the way, you are absolutely right that margins is pretty much where the disappointment lies for HDFC Bank in this quarter. And more than the percentage number of margins, Latha, what I would say is what has been disappointing is you remember, and I remember you doing pieces on this at that time, of ICRR liquidity that they were carrying and excess liquidity they carried during the merger of about 1 lakh crore, right? Most of that has been drawn down in this quarter in terms of investments and cash. And yet the margins are where they are. So, it's that same margin has applied to what has been a smaller balance sheet than what the rest of the street expected, which basically led to the disappointment that we have seen at the operating level at NII and POP. Now, as far as the rest of the sector is concerned, it's very clear, it has been clear for almost 2 quarters, Latha, that the peak that we had on margins in the interest rate cycle was already behind us. The question is, how much further do we have to go? And there we would have to say that, the margin moderation, the larger part of that for the sector is actually in the rear view mirror. So what we have now in the next couple of quarters is probably the entire amount of margin moderation playing out. And from that point onwards, it's something that HDFC Bank also hinted in its quarterly call yesterday, and something we have mentioned in our outlook note too, that given what US monetary policy stance is and what our own Market 360 team has predicted in terms of Indian interest rates, we expect a cut sometime in July, August. next year, right? And that's where the cycle reverses. At that point, you should also see CASA coming up, especially the savings account part, when the competitiveness vis-a-vis FDs starts to, the gap starts getting bridged once again. So at that point, the margins turn around. So is it disappointing for HDFC Bank? For sure. Does it break the long-term investment thesis that we have in the company? No, it doesn't.
Okay, fair point. I know it in your pecking order, it still comes very high. But
Yes.
Shantanu, just to stick a little more on the margins, two-part question. First, are you tweaking your expectations for the ICICIs and the Axis's and the IndusInds in the current quarter itself? Looking at HDFC Bank?
No, as of now, we don't see a reason to do that. I'll be honest with you, Latha. What would have been margins that wouldn't have surprised us? It would have been 10 basis points higher. And let's be very clear that entire disappointment is from loan yields. Borrowing costs have pretty much been, even in percentage terms, and both in terms of composition of liabilities and its cost, has been pretty much exactly what the market has expected. It's just that loan yields have not gone up, and that's surprising on two counts, Latha. You'd notice that they're not taking wholesale banking up a lot, and they've made it very clear that wholesale banking pricing is not that great. We don't want to do too much of that. So retail proportion is increasing. And even, in the non-wholesale parts, you see higher yield segments like CRB, which have shown higher growth. So frankly, what we would have expected is a 10 to 15 basis points higher loan yields, which would have been boiled down into 10 basis points higher, overall blended yields and passed down to margins. That's where the disappointment lies.
The
Now,
possibility is that...
for me to,
Yeah, go ahead. That's not enough for you to?
For me to say that, therefore, there's trouble brewing within ICICI or Axis in terms of a disappointment as well. See, the big unknown out here, Latha, is at what point within the quarter did they draw down the liquidity? To give you two extreme examples to illustrate my point. If they did it in the first week of the quarter, let's say, one extreme example, then this is very bad numbers. If they did it in the last week, then these are, this disappointment can be completely ignored. The truth will be somewhere in the middle, and we don't know where.
No, chances are it was towards the end, because I remember the money market gossip at that time in terms of some high HDFC business. So chances are it was December, but then I'm just talking from memory. Shantanu, more to speak about the impact on banking sector in the coming quarters. When if we take that the Reserve Bank starts cutting, sometime in June or the August policies, when you cut rates, considering that there is, EBL, the external benchmarks, the loan rates will fall first. The deposits will get repriced later. So we are going to have pressure on margins for all of calendar 24, you think?
Yes, two parts to that. I mean, of course, as you rightly said, the repo link stuff will immediately reprice, right? I mean, there's no lag there, and these are, these are not very high borrowings banks that the borrowing side will reprice fast. I mean, especially short-term borrowings, right? There are some NCDs they would have, inherited from the HDFC side, but the short-term borrowings proportion is small. So you're absolutely right. But what helps it 1-2 quarters down the line is the pickup in CASA then that you're likely to see, both because of the low base and also because the SA versus FD rate gap starts to narrow. I mean, just like they are suffering in that, they'll start to suffer. Also, another thing you have to keep in mind here, Latha, is that FD rates have hardly moved in the last 6-7 months, not just for HDFC Bank, for any of the large prominent banks. I mean, they would have moved 5-10 basis points here, there in particular buckets, but broadly rates have not moved in the last 6 months. And these high rates have been pretty much ongoing for almost 18 months now. And through that period, we would guess about 70% of the FD books of these are already repriced at those higher rates. So by the time the cut comes around, right, Latha, on an incremental basis, the pressure is not going to be that high on borrowings. But yes, from the yield side, there will be some initial pressure. So maybe, the second quarter of next year probably marks the first or second quarter marks the bottom in margins.
Okay, let me come to the other banks. I noticed that in your report, you're very positive, or you're expecting an upside surprise in IndusInd Bank.
Right.
I mean, is that very high in your buy ranking, and what should we be prepared for?
Right. I mean, I mean, there's one pecking order we have on for a 12-month investment basis. What you're referring to is the possibility of surprise in the current quarter, where I am
Yes,
rating
yes.
IndusInd high because of one simple reason. I mean, where's the disappointment in HDFC Bank, for example? The disappointment is on yields, and guess
Yes.
who has the highest fixed rate high yield stuff going, which is also growing at a fairly fast clip. So from that point of view, IndusInd's margins are likely to hold a lot better than most others,
Yeah, of
especially
course.
when others like ICICI
Yeah,
Bank, etc., are coming off a high base.
fair
You know,
enough. Yeah, I know
right.
they
So
are the
that's
ones who fund all the CVs and the commercial vehicles. So clearly, Innocent stands to gain. You're also extremely positive on AU Finance, both in the shorter term as well as in the medium term. It's one of those mid caps that's figuring in your list. Tell us why, and what should we be prepared for?
right. So, I mean, the long-term thesis is very clear. We see very few banks, or for that matter, even NBFCs today, which can replicate what can be called the Bajaj Finance miracle of the last decade, which is essentially, can you see 25% well underwritten margin protected growth for an extended period of time? And partly due to serendipity of its geography, and partly due to underwriting skills it has built over the last 20-25 years. This bank is one of the unique financial services companies which is positioned to deliver that. It reflects in the multiples as well. Now, as far as the recent quarter is concerned, margin pressure has been a reality for AU in this entire financial year, because their core segments, the high yield, high entry barrier segments like MSME and wheels, have actually slowed down sharply this year. And the reason behind that, what they have illustrated, is that some of these segments have seen new entrants. And that's not a surprise, Latha. Today, any NBFC that you speak to, including NBFCs that have struggled in the recent past, they'll tell you, we are entering MSME and we are trying to do, used vehicles. It is the feature of every NBFC cycle. And today there would be certain, untested players, so to speak,
Okay.
who would be jumping into the fray. So
Okay.
I mean, I'm not too bothered about the fact that they're backing off from that. But given where they currently stand on low-cost liabilities, there's enough and more backfill of prime assets to at least take care of loan growth for the time being, that it stays at that 25-30% basis. So
All right, got that.
on that,
Yeah. I'm sorry I'm rushing you, because I want to squeeze in a last question before I run out of time. Your main thesis is that even FY25, the banking sector, the big banks, are only going to post about 11% EPS growth. The fantastic year is FY26, where you're expecting 19-20% of EPS growth. If you can develop on that. So you start buying now. Are you having a buy on the big banks right now?
Of course I do, Latha. And so see, some of this wisdom is in hindsight. So let me be very clear. I was just as bullish last year also. But if you look at the full year performance, it's not played out to my expectation, right? You've got compounding in banking. So Bank Nifty would have done something like 12-13%. But the re-rating that we are all expecting has not happened. And as I racked my brains at this problem, I couldn't come up with a single reason why I didn't do so. Because earnings growth was pretty good this year, right? Margins, yes, it came off the peak of FY23, but nevertheless fairly healthy. No balance sheet problems in sight. No supply side problems on deposits. So and valuations which are frankly in most cases well below what their decadal medians look like. So best in decade fundamentals with below the average valuations. It didn't make sense to me until I started thinking in terms of earnings momentum. And that's the only reason I could come up with for the underperformance. That maybe people are focusing on the fact that the FY25 growth doesn't look that great. Now, the advantage to that sort of a prism is FY26 growth looks better and better. And as you go through the year, every quarter, the year-on-year comparisons are going to get more and more flattering at the bottom line level. And that's where I think the re-rating comes through. Because frankly, otherwise, I am just as mystified as you are by the underperformance.
Fair point. Fair point. I mean, so is the market, and today down about 2.5% as we speak, the Nifty Bank. And there is, of course, global pressure that's taking down the top big indexes as well. Thank you very much, Santanu, for joining us and helping us understand how the Bank Nifty may perform it is probably factoring in a modest FY25 as well, and the big gains come in FY26. That's the BNP Paribas view. Thank you very much for joining us on Bazaar Chartbusters after a brief break.